Welcome to the Deep Dive. Today we're digging into the latest earnings call from Fastenal. That's for Q2, fiscal year 2025.
Right, the industrial supplies distributor.
Exactly. And what's really interesting here is how they seem to be, well, thriving in what's still a pretty complex market for industrials.
Yeah, they're not just navigating it, they're turning some of those challenges into almost an advantage, it seems. Pretty impressive stuff.
It really is. So let's get right into the results snapshot for Q2.
Okay.
They delivered a modest beat. Revenue hit $2.08 billion.
Just sneaking past the $2.07 billion consensus, yeah.
And diluted EPS earnings per share that landed at 0.0829 cents.
Also a little better than the $1.28 expected, so solid, if not spectacular, on the headline numbers.
True, but what really caught my eye was the daily sales growth.
Oh yeah, that was strong, 8.6% year over year.
Which, is their best performance on that metric since way back in early 2023.
That's a significant pickup, definitely suggests some momentum building.
And the gross margin.
That ticked up too. 20 basis points, so 0.2 percentage points, landing at 45.3%.
Which is quite positive in this environment.
Right, absolutely.
Yeah.
Especially given input costs and tariff noise. They mentioned strong vending signings and pricing actions helped there.
And the market reaction? It seems investors were pretty pleased.
Yeah, definitely a positive response. I think the market appreciated the margin resilience and the relatively upbeat guidance.
Especially when you hear some other players talking about, ongoing sluggishness in industrial demand.
Exactly. It makes Fastenal stand out. It shows confidence in their ability to manage things like tariffs and just keep executing.
It suggests they're really gaining share, doesn't it?
It certainly points that way. So let's dive a bit deeper into that operational strength.
Okay. So that $1.29 EPS figure you mentioned, that was actually up 12.7% year over year.
Right. And that's adjusted for the 2-for-1 stock split they did back in May.
Good point. But the efficiency story, I think, is in the operating margin.
Agreed. 21% for the quarter. That's up 80 basis points year over year. Really solid improvement.
And that translates into, what, a 30% incremental margin?
Yeah, 30%, meaning 30 cents of every extra sales dollar is hitting the operating income line. Very disciplined.
It also talked about SG&A leverage, selling, general, and admin costs.
Right. Those costs grew slower than sales overall, which is what you want to see for efficiency gains.
But one component didn't leverage?
Correct. Bonus and commission expenses actually went up, but that was because financial performance improved so much.
So they could reward the team after a couple of tougher years.
Exactly. Management framed it almost like a built-in shock absorber for the workforce. Good for morale, you'd think.
Definitely. And cash generation looks strong, too.
Very strong. $279 million in operating cash. That's about 84.4% of net income, which they noted is above their historical average.
Plus, they keep a really conservative balance sheet. Debt's only, 5.7% of total capital?
Tiny, yeah. Very low leverage. And they announced the next dividend, $0.22, payable in Q3.
Now, one thing that might raise eyebrows is the inventory level. Up 14.7%.
Yeah, that's a significant jump. But they addressed it head on, said it's strategic.
Strategic how?
Well, it's about improving product availability, making their distribution hubs more efficient for picking orders.
Okay.
And also, they admitted they pulled some inventory forward, partly because of potential tariff impacts, being proactive.
And is it paying off?
They say it is. It frees up time for their field teams, less time chasing stock, more time talking to customers, helping with solutions.
Which probably helps the margin profile, too,
Yeah.
especially on those quick spot buys.
Exactly. So that inventory isn't just sitting there. It's an enabler for the sales team.
Makes sense. They also mentioned higher capital spending.
Yep, $64.3 million in Q2.
Mm-hmm.
They're guiding to $270 million for the full fiscal year.
And where's that money going?
Primarily into 3 buckets. More FMI devices, the vending machines and bins,
Right.
IT investments, boosting their digital capabilities, and more automation in their big distribution centers, specifically mentioning Utah and Atlanta.
So investing for growth and efficiency. It sounds like that strategic realignment they started back in late 22, early 23 is really clicking.
Management certainly thinks so. They directly linked these results to improved alignment and performance stemming from those changes.
We're seeing that in the sales momentum too, right? Contract signing.
Absolutely. Huge improvement there. They said contract signings grew from just 4% in the 22-23 period to 11.2% last year.
And in Q2.
84 new signings. beat their own expectations. And get this, contract customers now make up 73.2% of total revenue.
Wow, that's a big shift towards recurring relationship-based business.
It is. And looking at how those customers are performing, sites doing $10,000 or more per month saw revenue jump 11.6%.
And the bigger ones, the on-site locations.
Even better, those doing $50,000 or more monthly grew revenue by 14.5%. Really strong growth in their core segments.
Now, focusing on these larger accounts has meant fewer smaller ones, right?
Yeah.
Especially the really tiny ones under $100.
That's true. It's been a natural consequence. But management was clear their goal is actually to grow in all customer size categories, not just the big ones.
So how do they plan to do that?
Well, one key thing is the planned relaunch of Fastenal.com later this year.
Focusing on the website for those smaller, maybe spot buy type needs.
Exactly. And they think it can help capture business that their existing large customers are currently spending elsewhere, maybe 20 cents on the dollar, they estimated.
That could be a significant opportunity if they get it right.
Definitely. And another piece of this is their Customer Solution Consultant Program, the CSCs.
Right. How's that going?
Very well, apparently. They said it's a big driver of contract success, especially in regional sites and those 10K plus customers.
Yeah.
And they're still expanding that program.
Okay, so investing in people and technology. Speaking of tech, the FMI Fastenal Managed Inventory that continues to grow.
Oh, yeah. They ended Q2 with over 132,000 installed devices, vending machines, bins, the whole setup.
That's up 11% year over year.
Correct. And FMI sales now account for 44.1% of total revenue. Huge chunk.
Did they hit their signing goal for new devices? I remember they had a target.
They were just slightly below their sort of holy grail target of 100 signings per day. Came in at 101 per day. Wait, no, sorry, I misspoke. They were slightly above 100 at 101 per day. The goal was 100 per day.
Okay, so still very strong.
Yeah, and they explained part of the focus in 2024 was actually converting existing customers over to FMI, not just new signings. The long-term ambition is massive, though they want FMI to be 65% of sales eventually.
Wow. And what about just general e-business online sales?
Also growing strong, up 13.5% in the quarter, and it broke 30% of total sales for the first time ever.
So if you combine FMI and e-business,
you're looking at 61% of their sales now running through digital channels or managed inventory solutions.
That's incredible for an industrial distributor.
It really is. And they aim to exit the year somewhere around 64%.
Okay, let's switch gears slightly. Tariffs, always a hot topic. How are they handling it?
This was interesting. They've taken a really proactive, almost consultative approach with customers.
Not just passing costs along.
Well, they do have to manage pricing, but their focus seems broader. They built a system back in 2018 specifically to track tariff impacts and share that data transparently.
Okay.
They even talked about using things like duty drawbacks, getting refunds on tariffs for goods later exported, and even shipping product directly to Canada or Mexico to avoid U.S. tariffs altogether for some customers.
So trying to be a genuine supply chain problem solver.
That's the message. They want to be the best supply chain partner, manage the chaos, help customers make informed choices, not just react to price changes.
But they did mention a shift in customer conversations.
Yeah, a subtle one. During the worst disruptions, the plea was just don't shut us down. Now it's shifting a bit more towards price sensitivity, suggests maybe some fatigue out there about absorbing costs.
Understandable. But despite that, Fastenal raised its outlook for the second half.
They did, now expecting double-digit sales growth for the back half of the year.
Driven by
those strong contract signings we talked about, plus ongoing pricing actions.
How much impact did pricing have in Q2?
They quantified it at 140 to 170 basis points. So 1.4% to 1.7% of the sales growth came from price.
And more planned.
Yes, they indicated further actions in the second half that could potentially double that impact, though it depends a bit on how some deferred tariffs play out.
It reinforces that idea of them gaining share during disruption, doesn't it?
Absolutely. They have a history of doing that. Their sales structure, culture, technology, global reach, it allows them to adapt quickly.
And maybe customers are just looking for stability right now.
Management suggested that too. The strong pipeline might reflect a desire for safety and security from customers worried about tariff uncertainty. They gravitate towards partners they trust.
One last piece before we talk investor context leadership.
Right. They made a point of highlighting their focus on internal development, promoting from within.
Mention a few names.
Yeah, Kevin Davis, Bob Hopper, Scott Bailey, Bill Rickenbacker, experienced people moving into key roles. The idea is building leadership depth, giving senior folks some breathing room and empowering the teams.
That internal pipeline is often an underrated strength.
Definitely.
Yeah.
Ensures continuity, deep knowledge of the business, helps them stay agile.
So wrapping this all together for investors, what's the main takeaway from Q2?
I think it's the clear demonstration of operational agility and really strong strategic execution, especially when you set it against some competitors who are still flagging weaker demand.
It's a real divergence. The margins held up, guidance is positive.
And those contract signings and digital numbers show they can navigate challenges like tariffs and keep winning business. They seem able to pass costs through effectively while still growing.
And the market clearly bought into that narrative. The stock reaction, the volume, options activity, it all points to increased confidence.
Yeah, investors seem to recognize Fastenal's unique position, its competitive strengths in this tricky environment.
Their year-to-date stock performance is pretty telling too, right? Up 22%.
Yep, helped along by the stock split, some earlier price hikes in Q1, and those record vending installs. It paints a picture of a company driving its own growth.
Self-help, regardless of the broader market conditions.
Pretty much. It's more about what they are doing internally.
Okay, so you know where this is going. Time to put on our imaginary hedge fund hats for a moment.
All right, let's speculate wildly but plausibly.
Given everything we've just discussed, Fastenal's market share gains, the self-help story, the resilience, what kind of trade idea comes to mind? This is absolutely not financial advice, of course.
Of course not. Purely hypothetical. But you could think about something like a supply chain resilience pairs trade.
Okay, unpack that. What does it involve?
Well, the idea would be to go long Fastenal, buy fast stock. You're betting on their continued execution, the contract wins, the digital edge, their ability to manage tariffs and win business because of it.
Right, capitalizing on their strengths. And the other side of the pair.
You'd simultaneously go short, bet against a basket of, say, smaller, less diversified industrial distributors.
Why them specifically?
The thesis is that these smaller players likely lack Fastenal's global scale, their level of tech investment, and probably don't have the same sophisticated ways to mitigate tariffs or manage complex supply chains.
So they'd be more vulnerable.
Exactly.
Yeah.
More pressure from the generally softer market and more pressure from Fastenal actively taking share, especially as Fastenal makes that push into the spot buy market with the website relaunch.
So you're betting on the divergence. Fastenal outperforming while the smaller ones struggle.
Precisely. It's not just about hoping the whole sector does well. It's betting that Fastenal has the specific advantages of the better boat, if you will, to navigate these choppy supply chain waters, and that this difference will drive alpha.
Interesting concept. Again, purely hypothetical.
Absolutely. Just a thought experiment based on the trends we're seeing.
So boiling it all down, what really stands out from Fastenal's Q2?
So for me, it's that undeniable ability to generate their own growth. It comes from smart strategy, digital investment, and really doubling down on being an essential supply chain partner, not just a parts seller.
They seem to turn complexity, which trips up others, into their competitive advantage.
Well said. It signals that in today's world, with all the information overload and supply chain knots, companies that can actually cut through that noise and deliver real value, they're positioned to really thrive, not just get by.
A powerful message. Okay, just a reminder to everyone listening, this discussion was purely for informational purposes. It is definitely not financial advice.
Please do your own research before making any investment decisions.
Yeah, we'd love to hear what stood out to you from this. How do you see Fastenal's approach impacting industrial distribution going forward? Let us know. We'll see you next time for another deep dive.